Welcome to the latest Eversheds Sutherland Legal Insights podcast.
Hello and welcome to Taxing Lyrical, the Eversheds Sutherland podcast providing topical conversations for curious tax professionals. In this episode, we're going to discuss our predictions for real estate tax changes in the autumn budget on the 30th of October and how those changes may affect our clients. My name's Rebecca Sandwell and I'm a professional support lawyer in the London tax team at Eversheds Sutherland. I'm joined today by Paul Beausang and Charlotte Stodell from Eversheds Sutherland's London office. Paul is our head of real estate tax, and Charlie is also a partner in our real estate tax team. You may remember Paul and Charlie from our recent podcast on the abolition of SDLT multiple dwellings relief and the changes to land transaction tax which have been proposed by the Welsh Government. Charlie also joined me for a podcast on the changes to the UK's construction industry scheme, the CIS, which has applied since the 6th of April 2024. Many thanks, Paul and Charlie, for joining me on the podcast today.
You're welcome.
Clearly, there's a huge range of topics we could talk about in this podcast. So we thought we'd adopt a structure where I invite Paul and Charlie to each pick one change that they think is very likely to be announced at the budget, one change that may be announced at the budget, but it's less likely, and finally to make one wildcard prediction for the budget. So, Paul and Charlie, before we start discussing your predictions, please could you set the scene with some general observations about what we've been seeing from the Labour government so far in terms of tax policy?
Thanks, Rebecca. And it's really encouraging that I think you've segued neatly into something, letting us talk about probably one of the few positives that are going to come out of this budget. And I suppose when we look at the Business Partnership for Growth paper, the fact that the government's committed to capping corporation tax at 25% is definitely helpful, albeit there's a certain assumption that people don't look beyond that into the real effective rate of tax with stuff like corporate interest restriction and all the other things they've done which have driven up the real rate of tax. But it's nonetheless a pretty encouraging phenomenon. And the second thing, I suppose, which is good, is that they've retained the commitment to full expensing, which I think does two things, both of which are important. One is obviously the direct measure itself, which is the idea that you'll continue to encourage CapEx investment in the right sectors, and hopefully this will be one of the catalysts to increasing productivity. But the other thing that's desperately needed by the UK revenue on a macro level is some encouragement that there is a consistency of policy thematically, and the idea that we don't just keep jumping from relief to relief, which really just reduces confidence in inward investment.
Great, thanks, Paul. So some positives there. Charlie, is there anything you would like to add?
Yes, there is. I mean, I think one of the things that we need to look at is the commitment that the government has to what they call closing the tax gap. Of course, referring to the difference between the amount of tax that should in theory be collected by the government and the amount that is actually collected. I think the latest estimates were that the gap was around 5%, which in pure monetary terms equates to about £40 billion. So when we're looking at this black hole of £22 billion that they're looking to plug, it's no surprise that in April this year they announced further investment to close this gap, because it can make, it could make quite a lot of difference. When they published their plan to close the tax gap paper, which was excitingly titled, but did have some interesting points in it about the return that the revenue actually get for every pound worth of investment that they spend on compliance activity. Now, we know from being in the market and speaking to clients that HMRC are intending to leverage sort of advanced tech, AI and data analytics to identify patterns of non-compliance to detect and prevent tax evasion. And we know the government's looking very closely to use sort of graduates and people out of university to crunch those numbers and see what they can find. I think taxing non-compliance, there will be some changes that are made in the budget, and it may be that things like DOTAS, which is the disclosure of tax avoidance schemes, is widened, and whether there'll be a strengthening of HMRC's enforcement powers. That's all stuff that is quite likely to happen. But I think, interestingly, for the purposes of this podcast, is our anecdotal experience of the government actually seeking out opportunities to tackle what they perceive to be aggressive tax avoidance. And, we could talk to a number of key examples we've come across recently, but this includes in instances where they've actually issued a letter or what what a taxpayer would consider to be a clearance, and actually come back and I had another go at sort of challenging the position, which is it's a departure from anything we've seen before in terms of policy.
Yeah, so some themes there that we've seen in terms of Labour tax policy even before the general election that probably will be relevant to what happens at the budget at the end of October.
Yeah, absolutely. We could probably spend a whole podcast on what they're planning to do to close the tax gap, but that might be enough for today.
Okay, great. Thanks both. Let's now move on to your predictions for the real estate tax changes in the upcoming budget. What are your picks for the changes that are very likely to be announced on the 30th of October?
Well, I'll jump in because I think there's one that's very likely to come in, which is an increase to the non-resident SDLT surcharge. At the moment, it's 2%, and it's very likely that will be increased by 1% to 3% from the budget. But probably worth saying, and in a bit of positivity, we don't anticipate the other rates of SDLT will change, but the change to the non-resident surcharge will impact any entity basically that's corporate, that's owned by a beneficial owner overseas. So don't imagine it will impact investment too much, but something to bear in mind.
Certainly is from a context point of view, and Charlie's describing no plans to increase a marginal rate of up to 18% as a positive.
Well, that's true.
But neatly, that brings us into the capital gains tax changes, and happily there's no confusion because this is definitely not going to be positive. So there's sort of at least a couple of different things here. The very widely flagged ones is what we call carried interest. So they've committed, although they haven't got into the mechanics, the carried interests are going to be taxed as income. So the idea that if you have a promote or a co-investment as a investment manager, that you'll end up with a capital tax treatment and a marginal tax rate of, say, 24%, as opposed to 45%, that's clearly in the gun sights. And I don't think anyone really expects that to survive at this point. There is clearly going to be more work done on this in terms of what that does leave investment managers as options. And we certainly have some ideas on what you might be able to do in terms of sort of structuring pari passive investments at the same time as other people coming in. But there's no question that's both going to impact on the structures and on the attractiveness, sort of from a venture capitalist point of view, of carrying on the business in the UK. The other very widely flagged bit, which is almost harkening back to the Gordon Brown era, is the idea of realigning the income tax and capital gains tax rates. Again, I think it's been fairly widely trailed, but obviously that would have a huge impact on the attractiveness, certainly for individuals or co-invests, if you have a marginal gains rate of 45% on property. We'll have to see, but given again how widely trailed that is, that's looking pretty likely. The other one, which we've certainly seen some rumours around, is the idea of essentially rebasing. So at the moment, from an asset investment point of view, one of the things that owning property gets you when the owner passes away, from a capital gains tax point of view, the assets essentially rebase on death to market value. So there's no latent or inherent gain. It's not quite obviously a free ride, because then obviously the beneficiaries pay inheritance tax at a rate of up to 40% on what they get. There are suggestions that that will get looked at, which means you'd end up almost with a double whammy, because the estate on the one hand would pay capital gains tax for disposing of the asset, and the people inheriting would pay inheritance tax on what was left of the proceeds. If you look at that and combine the idea of having capital gains tax rates at income tax rate levels, you end up with potentially a marginal tax rate of up to 67% on the disposal of high value property assets out of an estate. So I'm not sure they'll go that far, because I think politically introducing anything that lets somebody throw those sort of rate numbers around starts to look pretty negative. But there's no question that that would have a very big impact, particularly if you bear in mind we no longer have indexation, and a lot of the gains we're talking about are arguably inflationary gains that are nonetheless locked into the property values.
Yeah, I think I would say to that as well. I agree with the negativity point, because I think that that is also referred to in the market as a double death tax, and you can see that being headlined.
Yeah, I think that's right.
Negative for the government. It's worth saying, isn't it, Paul, that we're seeing a change in behaviour just from the fact that these CGT changes have been trailed for so long. It's worth saying that actually that's triggering quite a lot of activity in terms of people looking to dispose.
Without question. And we are certainly seeing, as has been the case in many cases where any sort of measure has been advance notified, we're looking at people trying to coordinate transactions to finish by the 30th of October. Now, what we haven't had, and what we've certainly had with George Osborne, for example, previously, is an announcement there would also be anti-forestalling measures. So the idea that even though they haven't enacted the relevant legislation, they tell you now they will enact it with retrospective effect. So again, it's a guesstimate, but our current view is that if you do manage to execute your deal for 30th of October, or at least get an unconditional contract exchanged, you have a very good chance of avoiding whatever's coming down.
Although worth noting that when they did the allowance for what was entrepreneurs relief and is now business asset disposal relief, they did move the date of completion. So I think everyone is still looking out for.
I think that's absolutely right. I think you give yourself the best chance.
Yeah.
But I would not be banking that money.
No.
Yeah. So some pretty significant changes there. And I would just say in relation to the carried interest point, obviously the government opened a call for evidence recently, asking for submissions around potential changes to the taxation of carried interest. But given that increasing the taxation of carried interest seems to be a flagship policy of the Labour government since well before the election, it'll be interesting to see how much the government really take on board the submissions that it received in response to that call for evidence, which Eversheds Sutherland did actually submit a response to. Okay, so let's now move on to your picks for changes that may be announced at the budget, but are perhaps less likely.
Okay, I'm going to be greedy and jumping again first, just because I'm very excited about this potential change. The Reserved Investor Fund is something that we think there's really positive signs that the Labour government is still committed to bringing in. And the enabling regulations that were basically parked in July, we're seeing positive movement for them bringing this enabling regs into play. And I think it's really important because this is a positive move for the government to encourage a UK platform for real estate investment, which is similar but not the same as, you know, how the market uses things like Jersey Property Unit Trusts, which and given how prevalent JPITs are for property investment in the UK, this is something that would be very positive.
Yeah, it's nice to see that after only 2 decades of asking for a UK vehicle to replicate a tax transparent structure, that the government's finally minded to do it.
Well, I think we should be really positive about that.
We should. I can't be quite as positive on my sort of 50-50, because again, we're back to the black hole, and where can we get some cash? Because it's clearly not going to be from Charlie's riff. Pensions are very clearly in the spotlight again, and I literally think this is as simple as the government looking through the Green Book and going, what reliefs cost us the most money? And to anyone who looks at pension tax relief, costs an absolute fortune. And there is at least 2 different ways, I think, of attacking this. I think one of them, again, harken back to Gordon Brown and his idea of turning pensions into underfunded vehicles by abolishing without notice their ability to claim tax credits on dividends received. The equivalent to me of that is if they put employers' national insurance contributions onto the employer element of your pension contribution. Estimates are, I think, that could raise up to 15 billion. So I think economically what that will do is result in a gross down. So the employers will say, we don't suddenly magically have extra money, so we're going to have to effectively reduce the element of the employer contribution because we now have this extra cost, or we'll have to suppress salary. But one way or another, the cost will get passed down. The other way they could do it, but it's much more blatant, is to simply restrict relief to basic rate taxpayers. They could, of course, do both. And that would certainly bring in quite a lot of revenue. But again, on balance, I think tinkering with the relief that the employees get is probably a more newsworthy point. And I think if you're looking just to purely raise money without sort of creating as much attention, I think the easier way to do it is to stick the liability onto the employers and argue it's just a general employer cost, even though economically it's clearly going to cascade down to the employees.
Do you think there's any likelihood, just on that point, given this is a Labour government, of them potentially playing with the tax relief percentage so that some people actually get an uplift? So do you think they could bring in something like a 25% blended rate?
Yeah, that I think we've also seen some rumours in the market there, and I think that's a possibility. And you can see how it would impact on low earners. I think the danger of them doing it is that you need to be very confident in your economic forecasting. So if there suddenly becomes a way that the government's required to cash fund people's pensions when they're not up to now, I can see a danger. I certainly see a possibility of them doing it for the headlines and say we want to create equality, but I guess if they did that, you'd find in the fine detail there'd be some form of capping on how much the government have to contribute. So the whole point is if I'm bringing somebody up to 20% and it's a low paid worker, I might say I'm never going to have to pay more than £500 per person or something like that.
Yeah.
Okay, thanks very much both. So for the final section of the podcast, what are your wildcard predictions for changes that could be announced at the budget but are perhaps unlikely?
Well, following tradition, I'll go first again. I have two that I want to mention in this space. The first one I really hope is so wildcard that it never comes to pass. But this is the possibility, or something that people talk about, but in hushed tones, that has never been actually trailed by the government at all, is the possibility that SDLT will be applied to property rich company sales. So it actually attaching to shares at the moment on companies that are property rich. At the moment, they are subject to stamp duty and not SDLT. And that is something that would be a revenue raiser. But again, hopefully something that won't happen as my wildcard non-prediction. As a wildcard prediction that's more likely, I wanted to sort of throw out there, what's being talked about as a wealth tax. I think the government would probably acknowledge, and I don't think Labour have emphasised this at all in terms of something they might do, but it would be quite complicated for reasons of liquidity, people actually being able to pay this, potentially dry tax charge. But I think one of the ways that's been mooted is that they could have an annual tax on assets above a certain threshold, for example.
Mm-hmm.
But again, you've got no money to actually pay that tax. But what's far more likely potentially is an easy tweak to a system that's already in place. So we could see a rebanding of the council tax bands to basically hit what in the UK are most people's most valuable asset, being their property. And if they did that, and there have been some rumours that they might play with the council tax as a way of raising revenue, that could be sort of an indirect wealth tax applied to individuals.
And I suppose on my dark horse predictions, and to segue again neatly from Charlie's, I mean, if they did go and reband council tax, there's at least an argument for saying they might do the same thing with business rates. There's been huge clamour for that. There's no doubt that there's an economic disproportionality between how we treat online retailers as opposed to physical ones. If they're going to look at the whole council tax measure, at least there's a logic for them on an all-embracing basis looking at both. I suppose that could be encouraging, and particularly again for the hard-pressed retail sector. Sort of broadening it out more widely though, dark horse predictions, not heard any rumours, but it's interesting how a lot of these mechanics have been now put into the tax legislation in other areas. There's no doubt that the government, and to be fair, it's not the Labour government, this is a continuation of a Conservative policy over the last decade, has essentially been going after low-hanging fruit in a tax sense, one of which is individual landlords. We've seen the first holiday letting regime abolished. We've seen restrictions on interest relief. From a regulatory point of view, we've seen clamours to increase the energy efficiency requirements. Looks like the cost for that would fall on landlords. There's no doubt it's made the investment a less attractive one on a relative basis. What it's also produced dynamically, which is interesting, is a very clear incentive for individual landlords, those who are left in the market, to actually incorporate the business. So in some ways, the high rates of stamp duty and transfer tax now payable mean that there isn't really much of a disincentive to buying in a company anymore.
Subject to ASED
subject to ASED.
Yeah,
but if we're looking at
things,
people who are letting out the property, so
they would be exempt.
Yeah. You're looking at a scenario where you can buy in the property for roughly the same price. Your effective tax rate is only going to be 25%, worst case scenario, at corporation tax rates. You'll get full interest relief against your rental income. You have an element of control if you have made a profit on your letting over when you pay any personal tax on it, because there's nothing stopping you accumulating the cash within the company and then dividending out later when your tax rates are lower. All of which, as a relative investment structure, make it look, frankly, much more attractive than direct hold. But if, again, we look at the changes that have been made, and particularly in the areas like non-resident capital gains tax, and they've created measures to look through entities. I'm wondering if an enterprising soul amongst these 5,000 used hires they're looking at might suggest that they could reapply that legislation and possibly simply look through the corporate veil for individuals in this scenario as well. So you could literally say, treat the company like a partnership. And all of a sudden, all the negative tax things we talked about would come straight back. So effectively, you'd end up with a scenario where a person's liable to the rented income tax rates up to 45%. The interest restriction comes back into effect. There's no possibility of accumulating the cash at a lower rate within the company, distributing out later, because you're taxed on an arising basis. As I said, not really any rumours to that effect, but if you task me with the job of finding a way of sort of hitting BTR yet again, because that thematically seems to be what we're doing for the last 10 years or so, that's probably how I'd like to do it.
That's why they can't have you, Paul.
That's good. On a more encouraging note, because obviously we don't want to finish all of this, we need some rays of sunshine here. If we look, obviously, I mean, the whole non-dom issue has been politically highly sensitive, not least because of Rishi's spouse and others. I'm redefining the concept of loophole. So apparently, notwithstanding 30 years in the legislation and the relief working as intended, it's still a loophole. But passing, it's very clear Labour wanted to abolish non-dom, and at least partially, almost like school fees, I think that's for almost political reasons. And clearly, I don't think there's any chance that can be retrenched. But it's interesting that when this was originally mooted, again, I think by the Tories, the original estimate for tax raise was somewhere in the region of 3.5 billion. Rachel Reeves, when she was proposing her numbers some months ago, I think said the measure might raise 1 billion. And the leaked data now coming out of Treasury suggests it's not going to be revenue raising at all. So on the one hand, you know, we've managed to encourage a flight of capital. So presumably, is that a good thing? But from a consequence point of view, that's the result it's achieved. I think the bit we would probably want to think about carefully is the words non-dom are clearly politically toxic, but we're in a world where huge numbers of other competing states looking for inward investment in capital and entrepreneurs are introducing digital nomad schemes. And yes, we talk about these things in the context of mobile individuals setting up, running businesses, using a laptop overseas, whilst, you know, putting together a business empire. But the reality of what that translates into in tax legislation is eerily similar to a non-dom scheme. So I am wondering, and again, dark horse prediction definitely, is whether with the entrepreneurship flag waving wildly, somebody could say the UK, whilst abolishing the non-dom scheme, might need a digital nomad replacement, although clearly not linking the two.
Okay, so as you say, a ray of hope there at the end. Let's see what happens.
Absolutely.
So there we have it, our real estate tax team's predictions for the autumn budget. Thank you very much, Paul and Charlie.
Thank you.
Thank you.
As I say, we'll now have to wait and see what happens on the 30th of October. Look out for another podcast after the budget, which compares our predictions with the actual announcements and discusses the key real estate tax developments in the budget for our clients. Thank you for listening to Taxing Lyrical. We hope you've enjoyed the podcast.
Thank you for listening to the Eversheds Sutherland Legal Insights podcast.